Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger, and this is our weekly live Q&A. I see already a number of folks in the chat, so please give me a thumbs up if you can see and hear me. Got the thumbs up. So as you probably know by now, this is usually a couple of hours long where I answer some questions that have already been sent in by folks. I answer questions in the chat. I started last week. I added timestamps to the video and listed the topic or the question, and then you could just click the link that it creates and go right to that topic. I will do that again this week. I do that. Of course, I can't do it yet. I've got to do it after the live Q&A is over, and it takes me a little bit of time, but it'll be done today. So I will do that. I'm actually thinking of carving out some of the topics we discuss into separate standalone videos to publish, maybe down the road next week or whatever. That would be obviously much shorter, just be on one topic. One thing I see in the chat, a couple of things. If you want to ask me a question in the chat, please tag me in it because it shows up bright orange. One question I've gotten a lot lately, and Fast Eddie 333 just asked it. Now I'm going to start with some questions that were emailed to me, but I have a comment to Fast Eddie. You talk about the barbell withdrawal strategy or method. So I'd like you to clarify in the comments exactly what you mean by that. Or if you have a reference, a link, you can, I think you may be, I'm not sure if you can drop links into the chat, but you could type it out and maybe put a space in it so it doesn't create a link. The reason I mention that is because there is certainly the barbell strategy to investing, where the basic concept is you have very safe assets, think maybe treasury bonds, and then very risky assets, whatever those might be. It could be leveraged investments, but very risky. And that's it. You don't have anything in between. You could think of investments, particularly if we define risk as volatility, on sort of a continuum. The least risky thing in terms of volatility, there could be other risks associated with these investments, but in terms of volatility, the least risky, a certificate of deposit, savings account, short-term U.S. government bond fund kind of thing. And on the opposite end, I don't know, Bitcoin, leveraged ETFs, maybe a little bit less risky, but some form of stocks, emerging markets, short, small cap value that tend to jump around a lot. And so the idea is you'll invest in a lot of risky assets on the one side of the barbell, but you'll weight that with some percentage of very stable investments, but you won't have anything in the middle. You won't have balanced funds. You won't have maybe you could think of sort of more stable dividend paying stocks. Maybe, I don't know if you put REITs in the middle, but you're going to avoid the middle, right? So that's sort of the barbell strategy. And it's probably a very poor description of it. But my question is, I've done a lot of research because I've gotten this question from a lot of different people about the barbell withdrawal strategy in retirement. I can find very little on it, actually. So I'd be curious what you mean by that. All right. And then, so that's that. So we're going to get right into the first question, which was a great one. By the way, keep asking them in the chat. I will come back to the chat. This one was emailed to me from a listener named Parth. Nope. Yes. Is this the right question? Yes, it is. Okay. From Parth. I follow you and watch you on YouTube. Read a couple of your articles on your blog. Really admire what you do and information you provide. I've never missed your live videos. All right, Parth, are you here? I don't know. I don't see you in the chat yet. Maybe you're here. All right. I'll get to the question. He has basically two questions he asks. What would you suggest to young investors just starting out? And he put the age of like 18 to maybe 25. What advice would you give them? And what did you do when you were at that age? And did you invest or did you start late? So let me actually start with the second question, and then I'm going to give you 8 things. If I were sitting down at a table, at a coffee shop with a 20-year-old, what I'd probably tell them. So first of all, until I was 25, I was in school. So I went, undergrad, started out as an accounting major, loved accounting, but I switched to English because I thought I needed to learn how to write to be a lawyer. The funny thing is, and if any other English majors are out there, you don't really learn to write as an English major. I know that sounds kind of wrong, but it's true. I learned a lot about Shakespeare, for whatever that's worth. Anyway, and then I went to law school. So I didn't get out until, I was 25, I think. And so I hadn't saved anything. Uh, Last week, someone asked me my biggest regret or mistake in investing. And as I thought about it this week, my biggest mistake was not investing starting in high school. If I could go back, that's the one change I would make. I would have, I had a job, I was cutting grass and paper routes. And then in Ohio back then, you had to be 16 to like get a job at a grocery store or whatever. And literally on my 16th birthday, didn't have my license yet, had my temp. My mom and I drove around, I put in applications, got a job. And I worked all the way through high school after that. And then I worked in college, not all the time and not full time, but I worked third shift at a hotel, worked at UPS for about 3 weeks. That's a tough job, unloading trucks. And I wish I would have saved even if it was 10 or 20%. It wasn't like I needed the money. I wasn't paying rent. I didn't have bills. So I think that was my biggest mistake, was not getting involved with investing sooner. Now, after I got out of law school, I started investing pretty much right away, 401k, and I started investing on my own. Back then, it was a Legg Mason Value Trust because it was recommended by my boss. I didn't really know much. All right. So what would I tell someone today? So I would tell them, I wrote down 8 things that I would say to them. The first is, you've got to understand the awesome power of compounding. And I think I would show them this. I'm going to show you on my screen if this works. All right. This is just a Google sheet. Here's how I would explain the power of compounding. There might be better ways, but I would just look at a future value and I'd say, okay, let's imagine we earn 9%, and I'm going to divide it by 12 to get a monthly rate of return. And you're 20, talking to a 20-year-old. So let's just assume you work till you're 65. So you're going to do this for 45 years. So we'll multiply that by 12. Again, we're going to compound on a monthly basis. And we're going to assume you save $250 a month. Now, a 20-year-old may or may not be able to do that, but we're not going to increase this for inflation. So we're going to keep it static. Again, try not to argue with the numbers. You can obviously do this on your own and put in whatever numbers you want. And you can see the number already popped up. It's 1.8 million bucks. Now, yes, this is 45 years from now, inflation, I get it. But, we're only putting $250 a month in, maybe a lot when you're 20, but we're not increasing it at all. But here's the real point that I would want to show them. How much did we actually contribute? Well, $250 a month is what? That's $3,000 a year, right? Per year. And we did that for 45 years. So we contributed 135,000 and it turned into 1.8. So if you think about this, 1.7 million, more than that, was from compounding. Now, the 135 was from working hard, spending less than you make, saving each month. All the hard work was 135,000. The 1.7 plus million was just, I don't know, the cream, the returns you got for just doing nothing except, of course, saving that 135, $250 a month. And this is the thing that I think a lot of young people don't understand. If I told a young person, hey, I want you to save almost $2 million by the time you retire, and they're making $20 an hour, $15 an hour, whatever, they're like, that's just stupid, Rob. I mean, that's not, But what we need to see is, we need to see 250 or whatever amount you want to use. Obviously, the more you save, the more you end up with. But the point is, we need to see relatively small amounts of money in giant piles of cash, because that's what it turns into. So that's the first thing I would tell them. The second thing I would say is, look, the thing you have going for you, notice in that example, it was 45 years. And if you're 20, that's what you have going for you. You have time. You certainly have a lot more time than I have, at least based on averages. And what that means is, you need to start investing today. Forget baby step number 3. If you love Dave Ramsey, great. And if he helps you get out of debt, that's great. But the thought of young people throwing all of their money at low interest student loans for 8 years before they invest a nickel, it just is, that just probably, to me, about the worst advice you could give someone. So even if it's, $25 a month, fine. Start investing today. You can do other financial priorities. It's not all or nothing. If you want to pay down some debt, you want to save for a home, great. But you need to start investing today in order, if we go back to the spreadsheet, in order, to get all this to work. And in fact, let me just show you this, and I would show them this as well. I would say, okay, let's imagine you don't listen to me. You wouldn't be the first, by the way, but all right. and you wait 5 years. That's not that big a deal. You're still going to invest for 40 years, right? Whoops. There we go. Yeah, you are, and you're going to have a lot less money. You're going to have 1.1, 1.2 million instead of 1.85. Time matters. And even what may not seem like a big deal, 40 years versus 45 is a huge deal. So you really need to start investing today. The third thing I would say is, if you have a 401k, start there. Yes, the investment options may not be perfect. We could look at it. But there's some advantages to 401ks over IRAs. Now, there's some advantages to IRAs, but the advantages to 401ks, one, you don't have to worry about where you're going to open it, right? Your employer decides that. That's one. Two, they take it right out of your paycheck. You don't have to make the contributions yourself. I think you're much more likely set it up, and then hopefully you're going to forget about it, and you're just going to start saving money every paycheck. The third thing is, assuming it's a traditional, you may end up with a Roth, but if it's a traditional, it comes right off your income. When you get your W-2, that gets subtracted from your taxable wages. You don't actually have to, get the statement from like a broker on an IRA and make the deduction yourself. Again, none of this is hard, right? But I'm trying to remove as much friction as I can for a 20-year-old to start investing. And to me, the 401k is just easier. Now, if a 401k is not available, or who knows, maybe they're big hitters and they've already maxed out their 401k. That's great. Go with an IRA. I think for most, it would probably be a Roth, unless you're a high income person, particularly in a high income tax state. But I think for most people, it's a Roth IRA. That's the fourth thing I would tell them. That's perfectly fine in addition to a 401k, or if you don't have a workplace retirement account. And then the fifth thing I would say is, and I've talked to young folks on this, is look, don't worry about getting the specific investment right or making a mistake. If I were starting out today at $50 a month or whatever, I would just probably put it in an S&P 500 index fund, or maybe a total stock market. Now, there's an exception that I'll talk about in a minute, but yes, there's a 3-fund portfolio, and that's great. There's, we've looked at on this channel countless ways to invest your money. But if you're just starting off, you're trying to learn, you're a little nervous about all of this, just put it in an S&P 500 or total stock market index fund. You're going to have one or the other in a 401k. Obviously, if you open up an IRA, that's going to be available anywhere. Now, I'm a big fan of certain tools. I like M1 Finance. And so if someone said to me, well, Rob, I appreciate that, but I've opened up an M1 Finance account, or maybe I'm doing this at Schwab or Vanguard Fidelity, and I like a 3-fund portfolio, that's terrific. You're not going to get any complaints or objections from me. I'm just trying to keep things simple for someone just starting out. And that gets me to point 6. I do like certain investment tools. And one of them I haven't talked a lot about on this show is Betterment. And for those of you that know Betterment, yes, there's 25 basis fee. They have a 40 basis fee version as well, where you can talk to a live person. But if you just want their automated investment services, robo-advisor, it's 25 basis. And if you can do it on your own, like I do, and that you're comfortable with that, that's great. But I talk to a lot of 20-year-olds or people who are investing for the first time. Smart people, they don't want to hear about index funds versus actively managed. They don't care. They don't want to know about rebalancing. It's not that they couldn't understand it. They could, but it's just not, it's not who they are. And what I've come to learn is that you and I, that is the people watching this live stream right now, and me, we ain't normal. Okay. What we're doing right now on, I don't know what day, Thursday at 11 a.m. This is not what most people do. Okay. So all of these things may be simple for us, or easy, or comfortable, or we're happy to. Some of us enjoy this, I know, but a lot of people don't. And I can't tell you how many accounts where I've sat down with either a 20-year-old, and these are friends or family, or someone who's investing for the first time. And I just did this 2 weeks ago. They want to start investing. In their case, it was $75 a paycheck. I said, all right, we're going to open up a Betterment account, and I walked them through it. They answered a few questions. They got their standard portfolio. This happens in their case, happened to be a Roth IRA. They connected their bank account, and it's going to get invested for them automatically and rebalanced for them automatically, and it's perfect for them. And if I wanted to list all of the issues when it comes to money in their life, and this is someone I know very well, the 25 basis points that they're paying Betterment is somewhere way, 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 it's through the floor. That's how unimportant it is in the grand scheme of things. So I'm not saying you should use Betterment. I don't use Betterment, although I am looking at its tools as it relates to folks like me in or near retirement. But if I'm talking to a 20-year-old who just doesn't want to think about these things, just how do I do it? Just kind of get it over with and it's done. I would absolutely recommend Betterment. There are others, of course. Wealthfront's good, and the list could go on. The seventh thing I would say is really, really, really focus on spending less than you make, which sounds, I know you hear it all the time. But this is where I'd go back to the power of compounding. In fact, if we look at this sheet again, and if someone said, well, Rob, I'm going to really try to make a concerted effort and I'm going to save 300. Actually, let me make a duplicate of this so we can see the difference. I'm going to save $300 a month, not 250. The number starts to get silly big with relatively small amounts of money. And so, you really ought to focus on spending less than you can make. And that leads me to the eighth and final thing that I would say. And I talk a lot about this in my book, Retire Before Mom and Dad, and that is experiment, do life experiments. I was talking to some folks that retired early yesterday, and they retired in their 30s. And the wife, the husband was all in. He's ready to retire. They would be considered lean fire, if you don't know what that term means. But so these are not, multi-millionaires. And he was ready to retire, quit, done. She was very unsure about the whole thing. And so she did what I would call a life experiment. She took a sabbatical. Now, I know this is not necessarily available for everyone, depending on your job. But what she decided to do was, I'm going to take a 6-month sabbatical and try it out. I might not like it. I may want to go back to work. And after 6 months, she went back to work for a little bit and took another sabbatical. She still wasn't sure. That's okay. Take life experiments like that. And they could be on everything from, park your car for 2 weeks and don't use it. Turn off the TV for 2 weeks and don't use it. By the way, I have a car and I have a TV. So, but my point isn't to pick on these things or to say, the bigger point is these life experiments will help you learn what I think is the most important thing, and that is learning who you are. We think we know who we are. We think we know what we like and what we want. And then sometimes life surprises us and we realize, maybe we don't know ourselves as well as we thought we did. So there you go. Those are probably the 8 things that I would say. I'm sure I could come up with 100 more things I would say, but those are what come to my mind. So this is a great question, Parth. Hope you're on the thing. I haven't seen you yet. Maybe you're in here. I'm going back to the chat. All right, that's question 1. So I can mark that off of my to-do list, and I will go to your questions. Let's see. Yes, Scott mentions that the auto-saving feature, whether in or out of the workplace, is a key driver of wealth. Actually, studies show this. If you get, some companies will automatically enroll you in their 401k. You can take the time and the effort to opt out, but you get automatically enrolled. And study after study shows that more people save, and more people save more money with that. And I find it true, even whether it's a Betterment or Vanguard, wherever you open up an IRA, or a taxable account, even if you automate the process over time, you forget about it. You don't even think about it. It just happens. You don't miss the money. And absolutely. So Jerry says, love your channel. Any thoughts on stable value funds? I'm thinking of moving much of my bond allocation to a stable fund paying about 2%. So, and I had to get educated on this because stable funds are often available in workplace retirement accounts. I've never actually had access to one. And so I really don't have an opinion on them. I probably need to come up with an opinion. But, sometimes you guys ask questions and I just have to be honest. I don't have a strong opinion on stable value funds. I will make a note though and add it to my long list. My long list of things that I need to research. So Vinyl wants to know, what is your take on continuing to invest and save money in retirement rather than withdrawing and spending it down? So it's my preferred approach, actually. We're continuing to save and invest, although I guess technically So there you got to get into the whole thing about, what's retirement? Are we really retired? I feel retired. I mean, look, it's a Thursday morning. I'm here talking to you guys, but I make enough income on the side that we don't have to spend our investments. So I think from a financial perspective, that's probably not retired. I didn't think that was going to happen. It kind of just happened. But, I think if you're living the life you want to live and enjoying life and are content, I certainly wouldn't spend money just to spend it because I wouldn't spend money just because it's there. It's just not how I think about money. I think the bigger issue is why you aren't spending the money. And this is something that I've had to think a lot about. Am I not spending it because I'm just totally content and don't want to spend it? Or am I not spending it because deep down I'm scared to spend it? And that's where I get back to knowing yourself. I don't think that's always an easy question. And those that think it is may not know themselves as well as they think they do. I don't know. But I hope I continue to invest the rest of my life. I don't know how that's going to work exactly because it's fun. See, that's the whole thing. I think this is fun. All right. Going through your list of questions. Only tag me if it's a real question rather than just responding to things I say, if you don't mind. This will make things a little faster. Thoughts on a strategy whereby equity investments reach 15 to 20% gains, transfer to a bond investment, leave to compound, very hard to time. Yeah, Scott, this is the question Scott asked. If I understand the question, I just try not to time the market. Every time I've tried to time the market, I'm surprised and usually not in a good way. And I'll give you an example. And in fact, this comes up in a question, I believe. In fact, I'll just go to the question. The example has to do with bonds. So I had a lot in tips. I didn't like the negative yields, moved out of tips. Now tips are doing great, right? Because inflation now is coming to the picture. Is it transitory or is it not? When's it going to change? See, these are the kinds of decisions and questions I just have decided I'm not good at answering. And so I got an email from a listener named Carl. And so it kind of relates to this in a way. He said, Rob, I'm a dedicated subscriber and seem to recall that you've mentioned BND, which is Vanguard's one of Vanguard's bond ETFs. Lately, I am disillusioned with what I regard as with what I had regarded as BND as a safe, conservative place to put some of your portfolio. I have opened up an exploratory position with SCHP. We'll look at that in a minute. But I am wondering where the safe money is supposed to be nowadays. About to dump my BND and sink it in O. We'll talk about what O is. But I'm already oversized there. 60, low income, no real estate, wants to be FI with an option to work. So first of all, what's BND? Here it is. Let me make this a little bigger. We've talked about BND. So BND is a Vanguard bond fund, low-cost bond fund. It's got about a 6.8-year effective duration, which means if interest rates go up by 1%, the value of this bond will go down by approximately 6.8%. That's what duration tells us. And if the interest rates go down, the value of the fund would go up. That's how it works. And if you look at the types of bonds, got government bonds, about half. See that right there. I don't know how well you can see that on the screen. I've got it about as big as I can get it, a little bigger. 28% in investment grade corporate bonds, and then 23%, I think, securitizes mainly mortgage bond related bonds, mortgage-backed securities. So that's BND. He's not happy with it, so he's looking at SCHP. Let me pull that up. This is a Schwab fund. Whoops. T, right? Yeah. So this is a TIPS fund. Now, it's also an intermediate term bond fund. Its duration is a bit longer, 7.7 years as opposed to 6.8 for BND. I would, for our purposes, call those, comparable, but they are different. And it, of course, is a TIPS fund, Treasury Inflation Protected Securities. So how do we think about these two? And there's a behavioral side to this. So B&D doesn't invest in tips at all, right? So these are bonds that are subject to interest rate risk. If inflation goes up and interest follows it, B&D is going to go down in value. Tips are different, right? Because if inflation goes up, there's an adjustment that's made to the principal amount that basically protects us. You can think, as I've said before, you can think of a tip as like a treasury, but they've added an insurance policy that protects you, insures you against inflation going up higher than we expect. Of course, like all insurance, there's a cost, and the cost in the case of tips is a lower initial yield. But as we've seen, inflation's been up. So when we look, we'll take a quick look here at performance. Here's the tips fund, and we just look at performance this year so far. So this is Schwab. Vanguard has a tips fund as well. So we can see right here, it's up 4.41% year to date. All right, that's tips. And actually, I can see I had it right here as well. So let's move this one back to B&D. And if we go to performance, I think it's lost money this year. Yeah, it's off 1.82%. Last year it was up 771 as compared to 1086 for tips. In 2019, tips were at 852, and this was 884, so slightly better. So my concern, and I speak for myself, not for Carl, who emailed me this question, but it kind of goes back to timing the market is, well, I kind of got out of tips, and I may have had a reasonable reason to do it, or not. But now that they've started to really kind of perform better, am I going to now rush back into tips? I mean, I'm doing exactly what you shouldn't do, right? So I haven't done it yet, and I'm really rethinking my bond strategy. But I'm slow to make decisions. I'm quick to realize either mistakes I've made or how things didn't work out maybe the way I thought they would, even if I didn't change my investing approach. But I'm very slow to actually make decisions. So what David Swinson, who ran the Yale Endowment for many years, his sort of approach to bonds was half in regular old bonds and then half in tips. And now for him, I think the bonds were like intermediate term treasuries. I think you could use B&D, which includes corporate bonds and mortgage-backed securities, to take this approach as well. But effectively, what this approach says is, I don't know what inflation is going to do. I don't know what interest rates are going to do. So I'm going to cover my base. I'm going to have both. I'm going to have tips in case inflation's up higher than I thought it would be. Good, they'll do well. And I have treasuries or other types of bonds that aren't inflation protected in case inflation's not up higher than we expected. They'll do well. Now, notice I'm saying that inflation is not up higher than we expect. The fact that inflation is at a certain level doesn't mean that tips will do well, because there's a certain level of inflation that's already baked into the yields you see on tips. So really, it's inflation that's higher than expected. But in any event, so that's my take on sort of B&D versus the tips fund. I think they're both good funds. The real question is, how do you put them into your portfolio, and do you, whatever that decision is, do you stick with it no matter what? I personally would not go 100% tips bond portfolio. Now, for O is, to me, O is like a curveball, because O is a REIT, right? It's realty income. I'll show it to you on the screen. It's done phenomenally well over the years. It is a somewhat, I guess, targeted REIT, as opposed to, say, like a Vanguard REIT index fund, which would include O. And O is actually included, I'm pretty sure, in the S&P 500. I'm sure someone in chat will correct me if I'm wrong, but I'm pretty sure they're in the S&P 500. But this is done extremely well. It's just, I understand the thinking. The thinking might be, well, it's got a good, you can see it's forward dividend yields 4, roughly. So it pays a lot of income, and so maybe you can just replace the bonds. But it's much, much riskier than bonds. And I would really see this as part of a stock portion of my portfolio, not the bond portion. And so if you're thinking of moving from a bond like a B&D or whatever to a REIT, whether it's this one or some other one, then what you're really looking at doing is changing your stock bond allocation. is effectively what you're doing, in my view, which may or may not be a good thing. But I think step one is realizing what you're actually doing. So that's my take on that one, and it answers. So I got an email answered and a chat question answered. All right, Fast Eddie, I see your thing. Okay, I got it. So he's saying I need to look at the Heritage Wealth Planning, which I'm familiar with that channel. And okay, I'll check that out and either do a video or cover it next week. It actually dovetails into another email that I got and this book, which we're going to talk about. So let me find, here we go. Is this it here? Yeah, here we go. This email comes from a listener named Rich. He says, I've been following you for about 2 months now. Love your approach. I've learned a lot. You have made the complex so much simpler. I don't know if I've done that today. Maybe sometimes, but thank you. One question. When we begin to withdraw from our investments, and he says, let's just say 4%, do we withdraw from the bond or equity holdings first, or is there a suggested formula for how much to withdraw from each? It's a great question. We've talked about it off and on. So a couple of things to think about. The first one is we need to think of this at a high level. There are a couple of questions we have to answer as folks, either, if we're in retirement, we're pulling from our investments, or we're planning, we're close enough where we're starting to think, okay, how's this going to work? Of course, the first one is, how much do I take out each year? He mentioned 4%. That's fine, for our purposes. But, there's a lot of different ways to figure that out. But how much? That may or may not be consistent over your retirement. I've gotten some emails from folks, and I this is on my list, who say, I want to take out more initially, but then I'm going to get a pension or Social Security, and I could drop it, the payout later, 5 years, 10 years into retirement. And I'm working on ways to model that with tools like Personal Capital or New Retirement, and I'm still working on that. But that's point one: how much you're going to take out. Point two is your asset allocation, right? How you're going to invest your money. And point three, or consideration three, is more specific to Rich's question: how are you going to withdraw the money? Now, the reason I list those three is because they're not separate items. You can't just say, well, I'm going to take 4%. That's my choice. And in terms of asset allocation, I'm going to be 100% bonds. We need to recognize that there are relationships between these three things. And one decision we make for one of them could affect the decision we make for another. So, like, for example, in the 4% rule, Bengen tested 100% bonds and it failed a lot. And so if you were going to take out 4 or even 4.5% in year one and adjust for inflation, that may be a perfectly reasonable approach. But if you're going to have 100% bonds, unless you've got some other sources of income, that could be a real problem. So we need to realize that these three things are related. So his question really comes down to a term in this book, living off your money. This is, I'll leave a link to this after, below the video after we're done. It's a very dense book. Okay, this is like a manual. I don't know. I mean, it's got lots of complicated, detailed spreadsheets and charts, and some of you will love that. Others will hate it. Like, here's one of them. I always like something like that. I'm pretty sure I saw something very similar to this in the museum in London when we visited there many years ago. I think it helped us translate certain languages we couldn't translate before. Anyway, it is a good book, but it's dense. And the reason I bring it up is, in this book, the author, Michael McClung, if I'm pronouncing it right, talks about like a dozen different ways to think about how to pull money, which asset classes to take it out of. And I'm not going to go over them all. But we've got things like the Omega Knot strategy, the Weiss strategy, the three bucket strategy, the Guyton PMR strategy, Guyton of Guyton Klinger fame, two guys that have done a lot of research on retirement, the age-based strategy, the prime harvesting strategy, which is sort of a new strategy that the author recommends in his book. All right, so where does this all leave us? So the first is, this is probably the easiest and basic way to do this, is the rebalancing approach, which means And this is what Bengen did in his study. It doesn't matter from an asset allocation perspective. It may matter from taxes, but it doesn't matter from an asset allocation perspective where you take your money out. Say, let's say you take it all out in December for the next year, because you're going to rebalance. And so if you're whatever, 70% stocks, 30% bonds, even if you take it all out of stocks or out of bonds, you're going to rebalance. And it's going to be back to 70-30 when you're done rebalancing. This is assuming you withdraw first and then you rebalance. You could do that all in the same day, right? But you withdraw first and then you rebalance. From an asset allocation, the final outcome is going to be the same regardless of where you take your money out of. The other thing is, and this is probably my preferred approach, notwithstanding this book that argues for a much more complicated approach. But you don't need the bucket strategy anymore. I mean, the bucket strategy, the idea was, let's have whatever, 2, 3, 4 years in cash, so that if stocks are down, we don't have to sell them. We'll just use the cash. Well, if you rebalance every year, not only will you not be selling the stocks when they're down, let's say 30%, you'll actually be buying more because you'll be selling fixed income to buy the stocks when you rebalance. Now, so if that's the approach you follow, it doesn't really matter where you take the money out because you're going to rebalance. There are other approaches that might be sensible. One is the bond first strategy. You just spend down your fixed income. Michael Kitces has talked about this, where the result is you actually end up with a more and more aggressive portfolio in retirement, but it may take you 10 or more years to exhaust your fixed income, depending on your asset allocation when you retire. And let's say you retired at traditional 65 or whatever. So yeah, you may end up at 100% stocks, but you're going to be 75 or whatever, 80 when that happens. And so studies have shown you're probably okay because you're going to die before you spend all those stocks, even in bad markets, and you're past that initial sort of 10 or 15 years of retirement when sequence of return risk and sequence of inflation risk can be really, really difficult. So I don't know, that's my answer. If you really want to do a deep dive, you can get this book. I don't remember how much it costs. I got it from Amazon, I'm pretty sure, but it is, it's dense. I guess the real takeaway though is whatever you do, just keep in mind that your withdrawal strategy, how much you're going to take, is it a dynamic strategy? Will it change based on what the market does, what inflation does? But whatever that approach is, and your asset allocation, and how you take the money out, they all have to work together. Again, the simple approach is, to me, the simplest approach is probably assuming you need to spend this, start at like 4.5%, maybe 5%. Never take out more than about 6% of your portfolio, which means if it drops, you're going to maybe not get an inflation adjustment one year, or maybe even spend a little less one year if the market's really bad. Rebalance once a year. So which asset class you take from doesn't really matter. It's more of a tax issue at that point. That's probably the simplest approach. But, there's 100 different variations, and you may have a pension and Social Security that you can live off of if you have to. And so therefore you might want to take more risk. And, there's 100 different variations of all that. Okay. Here's a good question from, I'll just say call. If I were going to invest some in ticker O, which is the Realty Income, the REIT we just looked at, I'm pretty sure, by the way, it invests in things like, the buildings that like a CVS would be in, Walgreens, pretty sure. I'm sure there's other things too. Anyway, should I put it into a Roth, traditional, or normal brokerage account? Well, you shouldn't put it into a normal brokerage account because it pays a lot of dividends, and they're typically taxed as ordinary income because it's a REIT. So you really shouldn't put it in a taxable account. Between Roth and traditional, both are reasonable. I tend to want to put in my Roth those investments that I think over the long term should have the highest expected return, because I want to get my Roth as big as possible. But whether in your case that would be ticker O or something else, it also depends on how much you have in the Roth versus traditional. But from a tax perspective, both of those are reasonable options for a REIT. Okay, Jamie. Do you worry that the popularity of index funds, particularly the S&P 500, will cause an overvaluation of U.S. large caps and would prop up companies that maybe can't stand on their own can't stand on their own financials. I really don't worry about that at all. And if you look at the history, I mean, the S&P 500 has crashed many times. I mean, right now, if you think about the market, it's richly valued. I don't think it has anything to do with index funds. And I think it has everything to do with the money supply, interest rates. I mean, if you think about the Fed, they just announced they're going to start tapering. They're going to start to stop buying bonds. And their first thing is they're going to taper at 15 billion a month, which, yeah, that's a lot of money for you and me, but it's peanuts for the Fed. Yeah, I really don't worry about that. And also, we think about index funds as passive, but they can be used in a very active way, right? I mean, there are people that are buying in and out of index funds, trading options on index funds. I mean, there are people that are using what you and I might use as a passive investment tool in an extremely active way. And by the way, for that matter, I think you could be a very passive investor and invest in individual stocks or actively managed funds. We talked about American funds in the past. If you've owned American funds and stuck to it and had a plan and not changed it for the last 30 years, I view that as a very passive approach. There's an active element to it because the funds are active, but you can think of active and passive on a continuum. And the vehicles we use to invest in are just part of that. I've read stories of folks that became multimillionaires, but they didn't live like it, and they invested in blue chip dividend-paying stocks, and they bought them and never sold. And that was a pretty passive approach. I know they were picking stocks, so that element of it was active. But frankly, they were probably more passive than the index fund investor who jumps from one approach to another every 18 months. That's why I'm so slow to make changes. Even if I realize I've made a mistake. I put mistake with a small m. I mean, if I thought I was making a catastrophic mistake, I'm sure I'd probably do something about that. Vinyl says, and this is to a comment I made earlier, we may not be normal, but we have all the money. Well, can't argue with you there. All right. Here we go. Neil wants to know, are there any books you'd recommend about investing for a 10-year-old? I don't want my kids to be normal. Well, The Richest Man in Babylon, maybe, because it's a story. And maybe it's something you read with them. And it's maybe something you could implement, right? There are some interesting tools. You can just use a bank account, but there's some interesting tools out there. Greenlight's one that I like. Which is a debit card. It has an investment platform, but it's for kids. I don't know what the age limit is. You could just use, a savings account or something. But it's the reason I like that book. Obviously, it tells an important story, but then you could also put it into action, right? So maybe that one. I'm sure there are others. That's the only one that comes to my mind, Neil. All right, let me go back to an email question. So Vanguard Wellington, I've got a lot of questions about that, so we're going to look at it here. And this comes from a listener named Don, and it's kind of I won't read the whole email, but what he wanted to know basically was, he's a do-it-yourself investor, but what about sort of, maybe doing a do-it-yourself approach for half your money, and then the other half in Wellington. And he said, do you have any thoughts on using a managed fund such as Vanguard Wellington versus do-it-yourself? What are your thoughts on a half do-it-yourself approach and a half managed approach to spread some risk? I like the idea of a Wellington fund that has a selected set of stocks and bonds with a changing stock to bond split as they see opportunities. Okay, so first of all, just conceptually, I think an approach where maybe you're doing it yourself for some, but you're getting some kind of help for some other portion of your portfolio, whether it's Vanguard Wellington, which we'll look at in a minute, It could be a low cost advisor. It could be a robo advisor. Vanguard Digital Advisory Services are 15 basis points. And I've actually, even today, started thinking I may take a small IRA and put it in their services just to kind of see how it works. And if I do that, I'll share the results with you. I think it's great. In fact, someone mentioned in a comment to a video about dollar cost averaging versus lump sum. They said, just do both. If you're comfortable with this approach, take half of whatever your money is, lump sum it, and then dollar cost average the rest. And that's a perfectly reasonable approach. It's definitely not all or nothing. So I have no problem with that kind of approach. Now, the bigger question is, what do we think in this case of Vanguard Wellington? So let me show it to you on the screen. Let me make it a little bigger if I can. So this is a well-known Vanguard fund. It was actually founded like just a couple of months. Believe this, kind of hard to imagine, but they started it just a couple of months before the October crash in 1929. This thing is almost 100 years old. Yeah, it's older than I am. Anyway, it's relatively low cost. It is that. Here's the thing: it's an actively managed fund. Yes, Vanguard has a lot of actively managed funds, which may surprise some of you. It's actively managed. But it is inexpensive. It's 24 basis points, I think. Yeah, 24 basis points. So certainly more than their index funds, but pretty cheap for an actively managed fund. And we can look at their portfolio. So their stock style, they say, is large value. I have my doubts about that, actually. Let's see. Let me take the ticker. Of course, Vanguard, if they say it's large value, it's got to be. But some of their metrics made me wonder. So I'm curious what Morningstar thinks. Yeah, see, Morningstar has it as a blend. You can see that down here, but we can go to the portfolio page and see it bigger. Yeah, they have it right in the middle of the blend, which kind of makes more sense to me, and I'll show you why. But in any event, here they say stock is large value. The bond is right in the middle in terms of duration and credit quality. And we can look at that in a minute. But here's the other big takeaway. It's roughly 65% stocks, 35% bonds. And it's done exceptionally well over the years. We're going to look at performance in a minute. But it's done really well. It's got over 120 billion in assets. And we could come down here. Average duration of their bond is 8.1 years. So that would still be, it's on the high side of intermediate term bonds, I would say. Here's why, by the way, I was looking at this before the live stream, why I questioned whether it was value. Its PE for the fund is 24.5. That's actually a tad more than the S&P, not much, but a little. Price to book, right in line with the S&P. Return on equity, the earnings growth is lower than the S&P, but that's why I kind of wondered. And so I would view this as a blend, their stock. I think Morningstar's probably got it right. And then we can look at some of their holdings. These are the types of bonds they hold, which is not unlike the B&D, I would say. Investment grade. And then if we look at their top holdings, these are their top 10. You notice the order is different than the S&P 500. And of course, like Charles Schwab is not in the top 10 for the S&P. McDonald's is not. Apple was number one. I think Microsoft took that over, but they're really close. But their total assets for the top 10, 25%, which is that in and of itself is kind of normal, certainly normal for an S&P 500, roughly. So overall, I think, a good fund. Now, one of the problems with a balanced fund is that it's got stocks and bonds. So for example, if you wanted to put your bonds in a traditional retirement account and say stocks in a Roth, because we're going to grow more, you can't, with this, you can't do it. So you're getting simplicity. It's one fund. I mean, in theory, you could put, if you were fine with a 65-35 allocation in retirement, you could just put everything in this fund and you're done. It's simple and easy. But if you want to do more when it comes to asset location, what investments you put in what type of account, this is not going to work. And if you're not happy with that exact allocation, this is not going to work. And I think the bigger issue for me would be I would be too scared to take all of my retirement and put it in one fund, at least one fund like this. If it's a fund of funds, that's different. But even given its history, that would make me nervous. Now, The question though was, how about some of the money in this fund? And I think, some of the money in this fund would be perfectly reasonable. Whether it should be half or not, I mean, there's just too many other things to think about. But I think this is a reasonable fund. Now, one of the things that I did, I back tested this thing. Now, I didn't back test it very far because the data was limited. And here's what I did. Here's Vanguard Wellington, and let me make this bigger for you, if I can. And then I compared it to Vanguard's life strategy. Let me show you life strategy. I used the 60/40 life strategy, which is this one, and it's got less stocks, right? It's 59.3, so it's about 5% difference, which is significant, but it's as close as I could get. And this uses index funds, as you can see here. And then I also put in just a basic S&P 500, 65%, and a B&D, 35%. And I ran the numbers. And I assumed $1 million portfolio with withdrawing a fixed amount of 40 grand a year, rebalanced annually. And we could only go back to 2008 because of limits on B&D. I could have perhaps tried to find a different bond fund. But what was interesting to me is that, so I don't know how well you can see this, but Wellington crushed life strategy. I mean, I know that it's got a little bit more in stocks, but I was still surprised to see the difference. And I suspect part of the reason is that life strategy, which is here, includes international stocks, in fact, almost 25%. So I don't know about the international bonds, what effect that would have as compared to a US focused bond portfolio, but we know international stocks have underperformed. So that could explain part of it. But the other thing that was interesting to me was just a simple, S&P 500 and B&D fund outperformed both. Now, it didn't outperform Wellington by a lot, but it did outperform by a little. Standard deviation was a tad lower. And in fact, if we go back to Wellington on the Vanguard site and we look at performance, you'll notice, and again, hopefully you can see this, they have what's called a Wellington Composite Index, which I think is 65% S&P, 35% like a intermediate term bond index. And this composite, this benchmark has actually outperformed Wellington last 10 years, last 5 years, last 3 years, not the last year, underperformed a tad. So, my takeaway from all of this is not to run and embrace Wellington. I don't think it's a bad fund at all. And it adds some simplicity. But I think there's some downsides to it, particularly when it comes to asset location. If it doesn't have the exact allocation you want, you can't do anything about it. So could you put some of your portfolio in there? You could. The question I would have is doing that making your life simple or less or more simple? Is it simplifying your life at all? Because you've still got whatever you don't put in there to deal with. So in some ways, you've just added another fund. Maybe it does. And if it does, that's great. But those would be questions that I would think about. Okay. All right. Edwin asks, thoughts on paying taxes with pre-tax money? Considering you're over 59 and a half, one way to reduce pre-tax before RMDs. Well, paying taxes with pre-tax money. So if you assuming you're 59 and a half, you don't have your penalty, but you take your pre-tax money out, you get taxed on it. I mean, it does reduce it will reduce what your RMD is when you hit 72. That's true. But you're basically front loading the taxes. So, and that would be true, I guess, if I understand your question, regardless of what you actually use the money for, right? Whether you used it to pay taxes or not. And then the question is, well, what's your tax rate today versus what do you think it will be? And I know that's an impossible question to answer, but I mean, that's the world we live in. When your RMDs come into play, you can use tools like New Retirement, for example, will model this. But of course, New Retirement, there's no tool that can tell you what the tax rates are going to be. And there's, you can guess at what your income is going to be. But if it's 10 or more years from now, it's just a guess, right? So, I mean, the other thing I would think about is if I want to reduce my traditional balance in anticipation of RMDs in some number of years, of course, I've got to pay taxes, right, on whatever I take out of the traditional. But I would be thinking Roth conversion, maybe. Now, maybe I'm not sure if that's what you meant. Take out your question was in the context of a Roth conversion, and your thought is, I'll take out more than I want to convert, so that I can pay the taxes that'll get triggered from all of this. I mean, in an ideal world, you would pay your taxes with taxable money because it keeps more of your money in this case, a Roth. But I'm not sure that's what you were asking. And I'm not sure how helpful my answer was, but I tried, Edwin. All right. So Akeem says, in the Caribbean, we don't have Roth, 401k, etc. But you have great weather. So you got that going for you most of the time. And you can have bad weather too. Would you suggest using different ETFs for portfolio allocation? Simple to Dalio all-weather portfolio, or using individual stocks? Well, I think for most people, myself included, low-cost index funds are what make the most sense. I do have individual stocks. They represent about 20% of our portfolio, but they didn't start out that way. They were much, much lower than that. So if you're like me and you like investing in individual stocks, I think it's perfectly fine to take some relatively small percentage of your portfolio to do that. I think it's even fine if you want to gamble on crypto, as long as you understand what you're doing. I have a good friend, and we debate this all the time, and he's made a lot of money in crypto, but I keep telling him, you're gambling, that's fine. But he wants to give me, and he may even be listening, I don't know. But he wants to give me all of these reasons why crypto is a sound investment, and it's going to hit, Bitcoin's going to hit 100,000, and it's like, okay, all right, I don't, we can argue about that all day long, but I still think you're gambling. There's no intrinsic value. I like the folks in crypto talk about, well, I've moved some of my Bitcoin into fiat. I'm like, you moved it into a car? What'd you do? No, some currency that's not backed by anything. It's, oh, you mean like Bitcoin? Anyway, I think ETFs, low cost index ETFs, are probably, that's what I would do. Or mutual funds. If we're talking about like Vanguard, Fidelity, Schwab, well, Schwab, I don't know if they, but these are highly liquid, high volume. It doesn't really matter, mutual funds or ETFs. I prefer mutual funds if I don't have to pay a fee for them. Oric says, what about bond laddering? Minimizes interest rate risk. Yeah, you can build a bond ladder. I don't know how much it minimizes interest rate risk. I know in theory it does. Well, I shouldn't even say it that way. I think the perception is that it does. It's like if you own an individual bond, right? And so if you own a bond fund, its value is going to go up and down as interest rates change. And so we feel like we're either making money or losing money. So let's compare that to, you just buy a bond. You call up Apple. Hey, heard you're issuing a bond. I want to buy one. Here's $100,000. You get a bond issued by Apple. And you're never going to sell it. We'll just say it's a 10-year bond. So does the value fluctuate? Of course it does. Every single second the market's open, maybe even after hours. I don't know. I guess bonds trade after hours. I don't even know. It's just like the value of your home. The value of our home is changing every day. I'm not selling it. I don't think much about it. And if the bond you bought is paying 1%, and tomorrow Apple issues a bond at 2%, you're losing money. Now, yeah, you're not losing money in the sense that there's no account you can log into and look at a bond fund and say, oh, look at that, it went down 3%. But you've now got money locked away at 1%. That if it weren't locked away, you could get 2%. You're losing money. Just doesn't feel like you're losing money because you don't have some account balance. If you log into your personal capital dashboard, it's not going to show, the balance going down. But if you tried to sell it, you say, well, look, I want to get in on those 2% bonds. So I'm going to sell this lousy 1% bond. and I paid 100 grand, I'll tell you what, I won't even ask for profit. I'll just take 100 grand. What, who's going to pay you 100 grand for for the face value of that bond? Because it's only under 1%. They'd be like, well, wait a minute, why would I buy that bond? I can go give Apple, by the way, you can't actually do this, but you can buy it on the secondary market. In any event, I can give 100,000 to a new bond and get 2%. So why would I buy your lousy 1% bond? So if you wanted to sell it, you're going to have to discount it. How much? So that the effective yield for the person buying it equals what bonds are going for today, 2%. Having said all of that, hope that makes sense. If you want to create a bond ladder, I'm going to show you something here. Yeah. So here we go. The theory behind a bond ladder is, one theory would be, okay, I need so much this year, so much next, so much the year after, and so I'll create these bonds that mature at those times. And I don't think there's anything wrong with that approach. I just want to caution that just because you can't log into an account and see the value go down doesn't mean that a bond isn't losing money. And this gets me to BulletShares, because BulletShares, which you see on the screen, are bond funds, they're ETFs that act like individual bonds. They actually mature. You can buy one that matures at the end of this year, the end of next year. They have emerging market debt, corporate debt, and they have this bond ladder tool that you can use. So it's just Invesco.com/bond-ladder. And, we can give it a name. Well, we'll just use their name, my bond ladder. And we're going to, initial investment, we're going to do 100 grand. Build my ladder. And you can start, now you can see, we have the different kinds of bonds, right? There's emerging market, municipal, which you would only use in a taxable account because there's tax advantages, but whatever. And you can select your maturity range. We'll say we just want this for 5 years. We'll move it to 26. And it makes these suggestions, and you can see these funds where I don't know if you can see the dates there, they mature. So literally at 2023, the fund ends. It's over. You get your money back. And they allocate. You can change this, but they, based on what you put here, they suggest some funds, and they've got some. Let's see, some corporate bond funds. They've got, which would be investment grade, I'm pretty sure. You got municipal. They're suggesting. They're putting in a little bit of everything. No, just those two. Okay. Oh, that's right, because that's what I selected. Oh, yeah, I could select high yield as well. I could put them all. I want all of them. And you could use this tool even if maybe you didn't want to use BulletShares. But I think people creating bond ladders, BulletShares are, I think, pretty well known in that space. We can look at one of them. I think we've looked at them in the past. Let's see. I don't want to tell you anything. I'm an individual investor. All right. Now you're going to show me what I want to look at. You're not. Okay, Invesco, this is terrible. This is a terrible user experience. All right, I'm done whining. Here we go. Invesco BulletShares. Here it is. You can look at the portfolio. This is, what is this? Corporate. That's interesting. This is a corporate bond ETF, and 81% is in U.S. government securities. What year? It's probably because it's 2021, so it's going to end, right? And they're probably moving it to U.S. government securities. My guess is, just a guess, we'll just see if I'm even close to right. Let's go to this one, which is 2022. I'm going to guess there aren't government bonds in this one, but I could be really, really wrong. Yeah. I got lucky on this one. I guessed right. I think that's why, as it starts to get to the end date, they got to do something with the money, and they're not going to put it back into a corporate bond that matures beyond the date of the fund. Anyway, sometimes I forget you guys are even watching, and I just start talking out loud, looking at my screen. Oh, wait, this is a live chat. Hello. So yeah, I hope that helps. But yeah, that's a tool you can use. I would probably use BulletShares if I were going to create a bond ladder. I've thought about investing in them, but I don't know. I just trying to keep things simple. Jay wants to know what I think about VIGAX. Well, let's pull it up. I don't know what that is, but I know it. Oh, it's dividend appreciation. So sometimes I just can't keep all the tickers straight in my brain. The VIG, right? Yeah, I think I wrote about this for Forbes. Let's see. Did I put this in the top? Here we go. I think I wrote this article. Oh, that's what? That's not the article I wrote. Oh, well, I'll have to find it. In any event, it's done well. Where is it? Here it is. But, you know, it's got a yield of 155 over the last 12 months. And we can look at its portfolio. It's going to be a value. Well, it's dividend appreciation, so it could be blend. Yeah, it's close to the value line. The idea of dividend appreciation, so you can think about dividend investing a couple of ways. One would be investing in stocks that have high dividend yield. But dividend appreciation, I think this is probably the better way to think about it, is I don't mind a low yield. What I care about is it growing? That's what I really want. So like in my case, I think Apple has been an extraordinarily good dividend investment. I didn't invest in Apple because of the dividend. And in fact, I'm trying to think if it paid a dividend when I first invested in it. I think it might have. In any event, so I mean, this has been a solid fund. I guess the bigger question is how you're going to use that and what your portfolio overall is going to look like. In some ways, asking about an individual fund is kind of like asking about one ingredient in a recipe. What do you think about sugar? Well, maybe that's a bad example because sugar is terrible for you. What do you think about garlic? Well, I love garlic, although it's going to depend on what you put it in and how much of it you put in there. And so, if you want to focus on dividends, I don't think this goes crazy. So I think your performance is going to be reasonable. Some years it will beat the S&P 500. Some years it won't. If we go back and create a brand new portfolio, if we put in VIG and we compare it to VUG, which is growth, and then we compare this to, I'll use SPY because it's got more data. I mean, VUG is going to crush these two, right? Over the last decade, I think. We'll find out. Whoops, Rob, what are you doing? Here we go. Analyze it. Look at that. Yeah. So growth outperformed it. And that means the S&P is going to outperform it. Not by a lot, but right, because S&P is, in a way, it's dividend appreciation is not a value fund, right? We saw it. It's kind of on the line between value and blend. But a lot of dividend paying funds tilt towards value because those are generally the companies that pay higher dividends. In any event, growth has crushed it. Now, this is since when? 2007. Growth has just been crushing it. So growth kind of wins just about every race, every competition we could, comparison we could put up here. And that will change. When, I don't know, but it'll change. And there will be times when I'm sure dividend appreciation will outperform growth at some point for some period of time. There's no question about it. And it'll probably outperform the S&P 500 for some period of time. The bigger question is how much, what's your overall portfolio look like, what's your thinking behind using that fund versus just, let's just stick it in the S&P 500. But I think it's a solid fund. I like it. I don't invest in it, but I don't invest in a lot of really good investments. Chris wants to know what I think about the T. Rowe Price Ultra Short Bond Fund, TRBUX, or would you recommend another short-term bond fund in this current environment? I don't know. Let's find out. This is one I don't know. Well, you guys ask me a lot of them I don't know. But this is just one of many that I don't know. So expense ratio is 31 basis points. I'd prefer to see it lower, but that's not insulting. It's ultra short term, but its credit quality is medium. So let's take a look at what this fund invests in. So its duration is 0.74, so definitely an ultra short fund. So it has very little interest rate risk, which is why the highlighted box here is in this left-hand column. But its credit quality is in the middle. So let's see what it's investing in. So it's corporate, so it's a little bit of everything. It's got a lot in cash, which is kind of interesting. That would kind of trouble me a little bit. Why am I paying 31 basis points for someone to put 22 cents of every dollar in cash? I mean, I guess it's ultra short term, so maybe that's just the price you pay. Maybe that's how all ultra short term bond funds work. I don't know, but that's a question. This would probably be mortgages, I guess, but I don't know how you securitized. That's probably not. I'm not sure what that is. But corporate, let's look at its yield. It's not bad. I mean, given where rates are right now. So my take on that fund, looking at it for 60 seconds, is it's a reasonable fund for short-term money. It's not what I use. I tend to honestly put mine in a money market fund, which is probably, certainly, I wouldn't view as any better than that. Cheaper, I think. But it seems like a reasonable fund. I guess the bigger question is, what's the overall plan? How does it fit into your overall asset allocation? But it seems like a reasonable fund to me. So Double Dog Blitz. Double Dog, welcome. I don't think I've seen you in the chat. Maybe you were here last week. I can't remember. But in any event, talk about staying interested when you get to retirement. Hobbies, personal interests, how to balance so you can stay retired and not get back to work. It's a great question. I always assumed wrongly, but I assumed as I was thinking about retirement, and I sold my business 3 years ago, I always assumed, by the way, before I get to that, a short announcement. I am looking for someone who can take a YouTube video that I publish and turn it into an article, at least a first draft of an article. We can start with a transcript. I have tools that can generate my gibberish into a transcript, but it's a lot more work than you might think. Yeah, I'll just leave it at that. In any event, I'm looking for someone who I can say, okay, here's the video, here's a transcript of the video, now turn it into a coherent article. Yeah, we'd figure out sort of the hows and whatnot. I mean, this would be, I would pay you for this. I'm not asking for free work. So if you or someone you know is interested, reach out to me. Okay. When I sold my business, and at the time I thought I'm retiring. I'm not, I didn't know I was going to go work at Forbes. I didn't plan to start a YouTube channel. I didn't plan to start robburger.com, all of which make a little bit of money. It was, I'm done, I'm retired. And I thought retirement would be easy because I have so many interests: reading, fitness, chess, gaming, although I haven't done much of it, but I like it. And I got a gaming PC. Of course, family time, some travel. And I like learning. I've signed up for a Google class on data analytics. I've signed up for a course that I bought on search engine optimization, which has to do with getting the content you publish online in the search results. I like learning. So I thought it's going to be easy. And I went through probably a 2-year period, I would say, where I agonized over what to do. I took the job with Forbes. I did some work for the company that bought my sites. I still do. But I really agonized over what to do. And in thinking back on that, I think my concern, or I think what caused it all, was this idea that, how many more turns at bat do I have? I don't mean I'm going to, drop dead tomorrow. I hope not. But, if you start to think about big projects, or, you're going to get really involved in something, before you know it, 10 years go by. And I think it was like, I've got this, I see this hourglass with the sand falling through. And it's like, I got to make the most of what time I have left. So I could go do this. I love chess. Maybe I'll just study chess. And I did. I hired a Hungarian he's not a grandmaster, but maybe an international master. And in fact, I'm going to start taking lessons from him again. It was a lot of fun. But I would do that and I'd think, oh, I've only got so much time. Maybe, chess is fun, but do I really want to dedicate my time to that? I need to, well, you know what? I'll do this. And I kept coming up with these. Part of the problem is I had too many ideas. And so literally there would be times where in the morning I'd say, okay, I feel comfortable about this decision. This is what I'm going to do going forward. This is what it's going to look like. And by the afternoon, that was out the window. I was completely questioning everything. And it drove me and to some extent my wife crazy. I didn't expect that. Over time, I sort of just, you make decisions. What are you going to do when you get up in the morning? And I'm very comfortable right now with the decisions that I've made. And for me, they're the YouTube channel, writing on robberger.com. I have another site that I'm not doing as much work on, but I'm hiring some people to do some things on it. I'm still very active, with fitness. I haven't been cycling as much lately, and it's now getting colder. But so I'm very comfortable with it. But it was a very big struggle. So I don't know how much that answers your question, Double Dog. But the takeaway for me was just because you have a lot of interests doesn't mean that the transition is going to be easy. And I kind of do view myself as retired, even though I'm probably not, if you want to define it financially. But I view it that way because I don't have to do anything that I do. I get up each morning and decide what I want to do. If I want to shut down the YouTube channel, or my website, or not write for Forbes or whatever, I could do it. So I think it just took some time for me. It was a question of letting some time pass and figuring it out. Yeah. What's the name of the book again? I assume you mean this one, Living Off Your Money. And I see another one. Jamie, would you recommend any books for bond investing? Yes. Hang on. Well, of course I go out there and I can't find the dumb book, so I'll just have to show it to you online. It's called Bonds. Here it is, by Anne. Pull it up. Here it is. By Annette Thau, I guess. Excellent book. Very easy to understand. She does have some recommended bond portfolios in there, I believe, and I have the book. My library is right next door, and I don't know. I couldn't find it right away. So anyway, this is the book. I think it's excellent. All right. One question I had that I'll read briefly that got emailed to me. I'll just summarize it. And the question was, I've got Social Security, they've got pensions, and they could live off of that if they had to. They have investments, and their question is it okay to take more risks, given that I could live off Social Security and pensions if I had to? And the answer is sure. I mean, I think so. I think the question is going to be, why are you taking more risks, and how much risk do you want to take? But if you can live off your Social Security and pension income, you should. I mean, the thing that those will do for you is that when the stock market crashes, and it will repeatedly, you don't have to sell stocks. That's the real key, right? You can just live off your Social Security and pensions. And so, yeah, it's an enviable position to be in. You can take more risk if you want to. You don't have to. All right. So Ethan wants to know, when pulling money out of retirement, why not replenish the cash for living by selling stop losses on ETFs? So Ethan, I could come up with a strategy using stop losses. I assume what you mean is, what you're saying is you have stock ETFs, and at certain levels, you do a trailing stop loss or whatever. it's going to automatically sell. And I may not be describing what you have in mind, but I think generally that's what you've got in mind. And I'm just not a big stop loss fan. I'm just buy and hold and leave it there. And in the case of dealing with stock declines, I'm just going to rebalance every year. So if stocks are down, I'll sell some fixed income to buy more stock ETFs. That's my approach. I think it makes the most sense for me. I just don't like to get fancy, as you can tell. Every month I go to get my hair cut, and she asks me the same thing every time. So what are we doing today? And I say the same thing every time. Same thing as last month. All right. Jerry says, I seem to recall some research that too frequent rebalancing can be a problem. I withdraw monthly from the best performing fund, rarely asset allocation too far off. Okay. Yeah, there is research that suggests that. And in a past video, I talked about, I think it may have been a live Q&A, opportunistic rebalancing. And with that concept, remember, you're setting sort of bands where you'll allow your allocation. Let's say your stocks are allocated at 70%. You're going to allow it to fluctuate by what a lot of studies say is 20%. So 20% of 70 would be 14. So you would allow your stock allocation to go all the way up to 84 or all the way down to 56, I think. It's a pretty wide margin. One of the reasons behind that, there's transaction costs, which a lot of these studies factor in transaction costs. I'm not sure how important that is for us today. I guess taxes would be another one, though. But the idea is to allow momentum to work. And momentum is a real thing. I think turning momentum into an investment strategy is a whole nother matter. But momentum is a reality. And so they have found that that rebalancing too often can be less than ideal. And if you're taking out on a monthly basis and you rarely need to rebalance, I mean, that's great. There will be times when your allocation will be off significantly, right? And you might even take out in a way that kind of helps the rebalancing, right? Taking out from those asset classes that have moved up relative to the rest of your portfolio. But if that works, that's great. So Salty wants me to compare Wellington, which we looked at a minute ago, with another fund. Let me pull it up. Magellan ETF. So let me actually pull up Wellington in Morningstar. So remember, this is 65% stocks. So when I compare two funds, like I'm familiar with Magellan. I don't know a thing about its portfolio. So when I compare two funds, I look at expense ratio first, 24, and this is an ETF, 59. Okay. And I might look at trailing 12-month yield, not because I'm looking for a high yield per se. So this has effectively none, but it can tell me something about the fund, right? Like if I looked at a fund and the yield was 5%, that tells me this fund is deviating significantly from the market as a whole, assuming we're talking about like a large cap US stock fund. Obviously Wellington is balanced. In the case of Fidelity, there's no yield here, which is, again, I haven't looked at this fund in maybe ever, but it makes me question what's going on. And so it's a large cap growth. It's all equity. So the first thing I would say is there's really no comparison. They're totally different. This is a balanced fund. If you look at its portfolio, it's got 35% thereabouts between cash, fixed income, right? It's a blend fund, whereas Magellan has got effectively it's got a little bit of cash, as most funds do, but it's basically a 100% stock fund, heavy growth. So they're just totally different in my view. I'm curious what it holds. So it looks like a closet S&P 500 fund. That's my first reaction, but there's obviously some difference. Oh, Meta. That's Facebook. I said, well, what's Meta? That's an odd one. Oh, that's right. Yeah. NVIDIA, United Health. So those are different. I'm curious how this is done. So what would we compare this to? FMAG. So I would compare it probably to like a VUG, maybe. Why is it not coming up? Did I mistype it? No. FMAG. Well, we'll leave it in there and see if it works. We'll leave it like this. You can also throw in the QQQ. And actually, I'm going to change something. I'm going to change. Oh, there it did. Okay, good. So anyway, it's only for March. This is brand new. So this is different than the Magellan fund, right? Or it's an ETF version? I don't know. Yeah, so there's no data that's meaningful. So it looks to me like a large cap growth fund. I don't know why, it looks fine. It's expensive, right? I mean, if you go to like a VUG or even a QQQ, this growth fund, let's see how much it is. It's 39 basis points. QQQ, which is different for sure. It's 20 basis points. So I guess the one question would be why the higher fee and what am I going to get for it? So Krishna wants to know my thoughts on, by the way, Salty, I'm sure my last answer is not going to be satisfactory to you. So feel free to have follow-up questions. I don't know that I've ever given an answer that Salty has found completely satisfactory. I could be wrong. All right. Equal weight funds versus cap weighted. So again, just so we're all on the same page, S&P 500. If you were to invest $500 into an S&P 500 fund, what they don't do is take $1 and put it in each of the 500 companies. They divide it up based on the value, the market cap of the company. So let's say Microsoft or Apple is the largest. They're going to probably get $6 each, roughly. We can actually look it up, although Morningstar might be a little bit out of date. But we'll look up VU, which is Vanguard's S&P 500. And if we go to the portfolio, we'll see their top 10 holdings. So yeah, they still have Apple, which is no longer, I don't know if it's switched or not, but in any event, Apple is going to get $6. Microsoft's going to get about $6. Amazon's going to get just under $4, and so on. It's cap weighted. So if you go all the way down to the 50th, or excuse me, the 500th company, they're going to get a couple of pennies, if that. And you can imagine that gets really extreme with like a total stock market index, where you've got 3,700 companies. With an equal weighted, and I'm not familiar, or if I was, I just don't remember, but we can look up RSP. I may have talked about this in the past. It's an equal weighted S&P 500 is what it is. So we'll see the difference when we go to the portfolio. And I don't know why my internet is slow all of a sudden. So I apologize about that. But maybe it's Morningstar is slow. This is ridiculous. Here we go. So, you know, in S&P 500, the blue dot would be up here, large companies and blend. This one, the average company size is a lot smaller, not small, but a lot smaller, and it's moved more towards value. And if we go down and look at the portfolio, just the top 10, well, they call it top 10, but you can see they're all more or less equal weighted, right? And so the effect is with an equal weighted, you're investing in smaller, on average, it's all averages, right? Weighted average, smaller companies. And in this case, a little bit more towards the value. I don't see the point of an equal weighted fund. If there's nothing wrong with wanting small companies, mid-cap companies, maybe some more value companies. I would probably just pick funds that gave me that allocation. So I might have a total stock market index fund, but then have a small cap value fund or maybe a mid cap value fund. That's how I would create it rather than using an equal weighted S&P 500 index fund. Just gives me more control. So that's my take on it. But if you're interested in equal weighting, that's effectively what it's going to do to your portfolio as compared to S&P 500. Weighted average, smaller companies, and in this case, slightly more value. All right, Yuri says, I plan to sign up with M1 Finance using your 6-fund portfolio strategy. Transfer all of my Roth IRA funds from Fidelity that are held 100% in a Contra fund. Do you like my plan? I do, but I have some questions. No problem with M1 Finance, no problem with Fidelity. So one question will be, why not just do the 6-fund portfolio in Fidelity? Just a question. M1 Finance does make rebalancing a heck of a lot easier, and that might be your reason. Okay, that's fine. But it's just a question. Why go to the trouble of moving from Fidelity to M1? You may have good reasons. And then why are you in a Contra fund right now? And why are you switching to 6-fund portfolio? Again, a 6-fund portfolio is what I use. I think it's a reasonable approach. I think it's one of many reasonable approaches. But when I see someone, you're making a very big change, a dramatic change. It's fundamental to, I mean, you know, it's like saying, I'm going to root for the Yankees now instead of the Red Sox. I mean, you know, it's, hello, what happened? You know, by the way, I have no dog in that fight for you Red Sox and Yankees fans. It's a big change. So what's happening that caused that? And I think it's important to understand why you're making that change. So that, I mean, because the real key is going to be whether you stay at Fidelity or go to M1, whether you do a 6-fund portfolio or a 3-fund portfolio, whatever, are you going to stick with it? And going from a Contra fund, you know, to 6, that's a big change. So it's one obviously the 6-fund portfolio is what I use. So it's one of many approaches that I believe in. I'm not a Contra fund investor. So my point here is not that I think the Contra fund, I don't know which specific fund you're in. I don't know if they have more than one. They must have more than one, right? But it's such a big change, it makes me wonder, like, what's going on? And why are you, maybe it is the Contra fund, which is FCNTX. If my internet worked, I would show you. Really slow. But those would be my questions, like why that's a big change. If my internet works, I'll show you the Contra fund. What role do Ginnie Maes play in the portfolio? And by that, Wilma, I'm guessing you mean mortgage-backed securities generally? So here's the Contra fund. I'm assuming this is the fund he means, because you could also use a Contra fund as sort of a generic term. And this would be, this would, I assume, is a value. Whoops, that's not what I wanted to do. Shoot. VCNTX, let's go over here. Or FCNTX, sorry. Wow, it's slow. Well, we'll come back to that. I can't believe, I don't know, it must be my internet, but that doesn't make any sense at all. I have like the highest internet speeds that Verizon Fios offers. All right, it's back. So if you go to the portfolio, oh, this is super growth. Huh. I was thinking, I don't know why I was thinking something totally different, but I was. It's on the, did I see that it's on the pricey side? It's 86 basis points. So yeah, but my point still stands. You're making a big change if you go from this fund to a 6-fund portfolio, which is going to be blend, S&P or total stock market, some small cap, international, some REITs, some emerging market, big change. And this fund has probably served you very well over the last decade, like all growth funds have. I mean, look at some of these returns. It's ridiculous. And so I personally would be much more comfortable having my portfolio in a 6-fund or 3-fund or whatever portfolio than this growth fund. But it's a big change, and I guess I would ask you why that change, and what you're thinking. Why are you changing now? There might be reasonable answers to those questions, but I think understanding the why is important. So Wilma, I don't know if you want to add another comment. I mean, it depends what kind of bond portfolio you have, right? I mean, you're going to have mortgage-backed securities in a B&D, but you're not like in a treasury or a TIPS fund. I don't have a strong opinion on whether you should. Some argue you shouldn't. That if you own a home, you've got some exposure to real estate, just stick with treasuries and TIPS. I struggle to form a strong opinion on that point. So Jamie says, could you share what you think about funds that track indices, but with weighting towards different financial ratios, like Invesco's GARP fund, which I assumed is not a reference to the movie, but rather growth at a reasonable price, or the iShares World Value Fund? Well, so I'm sort of in my heart, I'm a value investor. So I'm a big fan of that kind of thinking. However, when it comes to index investing, I'm much more comfortable, for the most part, just going right down the middle. And because what's going to happen, as we've seen it, growth can outperform for a decade, then value can outperform for a decade, and you get whipsawed back and forth. And for me, it's just easier to just sort of try to stick right down the middle for the most part. And I know that down the middle is always going to underperform either the growth or value side, because one of them is usually going to be overperforming. But that's okay. I'm never going to be seriously off the mark, and I can get value through the individual stocks that I own. That's been my approach. I'm not familiar with those specific funds, although we can look them up. I probably like them. So the GARP ETF is SPGP. So let's look it up here. And I think maybe my internet's doing a little better. So growth at reasonable price. So the portfolio, so this is, it's got a 70 basis point yield, 36 basis point fee. There's my 3-fund portfolio. Well, that's not my 3-fund portfolio. That's a 3-fund portfolio I created for you guys for past videos. Why did it come up? Because I hit the wrong portfolio. Here we go. Yeah, so it's going to be, it's still a blend fund, a little bit smaller. That kind of surprises me, but I guess it's still they're trying to balance growth and value, right? So maybe that I guess that maybe does make some sense. I'm curious what kind of companies. Huh. Yeah, so if you're going to invest in a fund like this, it's going to take more research, right? Because you're going to have to really understand how they're picking these funds, what metrics they're using. But I like the concept. It's just the bigger issue is going to be what place it plays in your overall portfolio. Is this going to be your S&P 500, right? This, you're going to not have a standard S&P 500 index. You're going to go with this instead, and probably long term it'll probably work out fine. But there certainly will be years when you significantly underperform, and so you just have to be prepared for that. So again, my approach for the index fund portion of my portfolio is to maybe just keep it right down the middle for the most part. I've had some small cap value, but for the most part, keep it right down the middle. I think I like that investing style, growth at reasonable price. And I'm sure the fund will do well over the long term, but it will underperform too at times. Michael wants to know a suggestion for an asset allocation for taxable account. He's currently 80% VTI and 20% BND. Obviously it depends on your goals, how long you're going to invest and all that sort of thing, but that's not an unreasonable portfolio. Some would say, well, the bonds should be in your maybe in a traditional account if you can allocate it that way. And there's an argument for that because you're paying ordinary income on the interest. Of course, we all know that right now, bonds don't really pay interest. That's so 1980s. So you're probably not paying a lot of taxes. I don't know what the bond distribution, B&D distributions have been. We can look it up. But so at least at the moment, you're probably not getting killed in taxes. But I'm just looking at their what's their trailing 12 month. I can show this on the screen. It's not great. That's 2%. Okay. So, you got to think about the taxes. That would be the big question, but simplicity, I think, is great. I don't have any issues with that portfolio at all. For those who want really aggressive growth, this is from Curious Mind, and Curious Mind is curious. For those who want really aggressive growth in the next few years, I was wondering if 20% Apple, 20% Microsoft, 40% VTI or VUG, and 20% SCHD, the high dividend fund from Schwab, would be sensible. Well, there's a big difference between VTI and VUG, so you'd have to make a decision there. I suppose if you were really going for aggressive growth, you'd go with VUG, right, over VTI. The thing that would worry me about this portfolio is, one, it's high concentration. You got 40% in two companies. And valuations. I own Apple. I don't own Microsoft other than through funds, but I own shares of Apple. You've got high concentration, you've got high values. Of course, I guess in some ways everything is valued high, but VUG valuations are high. I suppose you could say, well, go with VTI to bring the valuations down a bit. But I could see this portfolio, look, this is all guessing, but I could see this portfolio not doing great over the next 5 years. How long can we keep doing this? It's just ridiculous. The markets, they're kind of flat today so far. Although my banks are down big time. I just, how long can they keep doing this? The other thing I'll say is this is just not how I think about investing. I don't think about, how can I accomplish, in this case, aggressive growth over the next few years? I think about what can I buy that'll never sell? That's true if I'm buying individual stocks or my ETF portfolio. Jamie wants to know if I enjoy correspondence chess. Not really. A good friend of mine who unfortunately has since passed away, we started a few games. This was before the World Wide Web. And, it's just too slow. I guess now they do it by, I don't know if they do it by email now. I assume they do. there are people that are big time into correspondence chess, and the games they produce are just incredible. But I've just never. Scott wants to know, why is SCHD a better investment compared to VYM? I don't know that it is. Did I say it was? I don't remember talking about VYM. Am I in trouble? What did I say? So VYM is high dividend yield. SCHD is the Schwab high dividend, or US dividend equity, which is a great fund, by the way. This one's got a yield of 274, trailing 12 month. This is 288. We could look at performance. I mean, they're comparable. Let's see, this is Schwab, 25% so far this year, 22. Last year, Schwab crushed it, 15 versus just 1 for this one. 19 was 24 versus 27. So yeah, Schwab has certainly outperformed. Now, I don't know, that's just 3 years, of course. And I also don't know what the difference is in the portfolio. Not much. I mean, in terms of investment style, not much. I don't know why. I'd have to dig in to see why Schwab has done so much better. But, I mean, I think they're both good funds. Yeah, so, I mean, the Schwab fund is sort of the popular, I think, probably one of the most popular, dividend funds available today. It's the one that most people, it's probably one of the most, when I get emails from folks, it's one of the most asked about funds. It's just done really well. But I don't know that I would, maybe I've compared it to VYM in the past. I don't know. I'd have to do a deeper dive. Salty, you wouldn't believe how much I pay for a haircut, but she's worth it. So Mike wants to know, do you think that the modern US market has natural downside protection, as the government is usually accommodative? Hence, investment can be biased towards equities. No, I do not believe that. I understand the government has been accommodative, although they're not, and I think the Fed is a little too concerned about the stock market, but I don't think it's their main concern. I certainly think stability is a concern for them, and the stock market is part of that. But no, I think we're going to pay the piper. We just can't. I know there's some that think we can't. Some think we can just borrow to infinity and beyond. I just don't believe that. And I've got a book that I bought on the deficit myth or whatever it's called that I need to read. I haven't read it yet. So I think the view they espouse in that book is that borrowing is, we can basically do it forever. I'm sure they say that in a more intelligent way. But I don't believe it. And, we're to the point where we're just silly policy proposals. And this isn't even for one party or the other, but silly policy proposals. We're like, we talk about spending money like we can just continue to spend trillions and trillions and trillions a year, and it's okay. It's all going to be fine. I don't necessarily think we're in for some, Thunderdome kind of end. I'm generally not a pessimistic person, so I'm not usually, you won't find gold in my house, because I think, the currency as we know it is going to end. I guess now it'd be Bitcoin, right? But yeah, we can't keep doing what we're doing. We have to. I think we have to realize that we're in a cycle, and it will end. Don't know when, but it will end. And we can say that the Fed is accommodative, for example, and there may be some truth to that to a point, but that doesn't mean we can't lose 70% in the market, right? We can. and we're gonna have bad times. I really hope, I assume I'll still be doing this YouTube channel when, we're down 50%. It'll be interesting I wish I could save all these chats. It'd be interesting to see what the questions are then versus what they are now. But Mike, I think we're gonna be at some point, it's gonna get ugly. It just will. Sai wants to know, if you have a money market account and already hold a lot of stock, would it be ideal to invest in some Bitcoin or Ethereum, to grow a little faster to eventually help pay off mortgage loan? No, I do not believe that would be reasonable. Well, you didn't ask the yes, it would be ideal. It would not be ideal. I don't think it'd be reasonable. And here's my thinking. If you want to invest in Bitcoin and Ethereum or other cryptos, I think, go ahead. I mean, there's part of me that sometimes thinks I should throw some money in. Who knows? Maybe someday I'll come on the live Q&A and tell you I've put some money into Bitcoin. I don't own any right now. And my $2.07 that I invested in, what's it called? I don't even know the name of it. It was down to like $1.80. Shiba Inu, is that what it is? I'll look up my Coinbase account. Maybe I'm a billionaire and I don't even know it. Here's the issue side that I see, is that it's the question, it's the way you phrase the question that concerns me. Certainly, if you invest in Bitcoin and Ethereum and it goes up by, a lot of money beyond where it is right now, and it allows you to pay off your mortgage, that would be great. But I don't view it as investing, because it has no intrinsic value. It's going to go up as long as people are willing to pay more, and eventually that's going to end and it's going to come down. So the real question, I think, is it reasonable to take some small percentage of your portfolio and risk it on a crypto in the hopes that it will go up? That, to me, is the right question to ask. If it's a small amount, I don't think it's crazy to do that if that's what you want to do. It's not what I do. I would never risk anything beyond a very minimal, even insignificant amount. And I know people have made a fortune. But people have made a fortune doing a lot of things. People make a fortune every day playing the lottery. So I want to tell you what my crypto is worth. I got to do the two-step verification, two-factor authentication. And hang on. I invested $2.07 of my hard-earned money. That was the book falling off my desk. $1.29. $1.29. It's an outrage. Well, I guess if I sell, I've got maybe a tax write-off. All right. Jack says, appreciate all the insight and guidance you provide for us each week. Thank you. I'm not sure how much insight and guidance I've given this week, but I try. Okay. Jack says, one of the most important things you've said is that switching from one perfectly reasonable allocation to another perfectly reasonable allocation is not good. You've made me think before trading. Yeah, that's the tricky thing. And it's so easy to fall into that trap. And oftentimes we'll do it in small. That's why the whole Contra fund to 6 fund, that was like, wow, that's a big change. But oftentimes we'll do it in small. Let's just put 10% in growth, or just 5% over here in a dividend fund, or, we don't do it all at once. And I've been guilty of it. Fortunately, I haven't been guilty of it very often. But I kind of am guilty of it on the bond side of things. I got short term. Again, it's the kind of mistake that won't kill me. But I probably should have just kept everything. I had 50% of my bond fund in tips, 50% in treasuries. Intermediate term, I should have left it alone. I didn't change all of it. It wasn't like I went to, it's not like I took it all and went to emerging market debt or anything crazy. But I definitely went shorter duration. Yeah. I think, it's just bonds are so expensive, but so are stocks, and I don't make changes to my stock portfolio. So Larry says, I started a Roth IRA on M1 Finance 2 years ago using the 2055 target date retirement PI. Now I am wondering why there are so many ETFs seem to overlap. So, and he gives some examples. Let me pull it up on the screen. I don't know that I can pull up that. Well, that would be a pie that's available, right? Let me, I'd like to look at this. This is an interesting question. I'm going to actually log into my account. I might have more access. To the research. Hang on, I'll show this in just a second. Expert pies. So just so you know, I've logged into my account. I've gone to research. These are my pies that I've created over the weeks, and I've shown many of these on the show. These are expert pies, and so these are pies you could use if you opened up an account in M1 Finance, or if you have one, or you could just use them to look at them and see what's in them, and you could obviously implement these at, I guess, any broker. So 2055, I don't know which one you use because there's more than one, but we'll just say 2055 moderate. And here they are. So this is the thing about M1 Finance, or a robo-advisor for that matter. I would never want this portfolio, like in Vanguard or Fidelity, that I had to manage and rebalance. That'd drive you crazy. But inside a robo, or in this case M1 Finance, you can just auto rebalance, particularly if this is an IRA or whatever. And the fact that there's all this complexity doesn't matter from an account management perspective. But back to Larry's question, he's saying there's VB, VBK, and VBR. So, okay, so here's VBR, it's small cap value. Here's VB, it's small cap. And here's VBK, small cap growth. And Larry, I get your question. This doesn't make much sense to me. Why not just take 3, 6, 10% and put it in small cap? That's effectively what you're doing. I guess there's 1 extra percent in value. So I guess you're tilting this a little bit towards value. And as I recall, because I've looked at these funds before, the value fund and the growth fund added together don't actually equal the small cap fund. I think there are some differences, as I recall, but still, I don't know why they do it this way. By the way, you could add this portfolio to your account at M1 and then modify it. You don't have to keep it with the way they've done it. So I don't know why they've done it this way. Now, the flip side is, because it's M1 Finance and you don't have to worry about managing it, one answer is, yeah, but so what? If that's what they want to do, I'll just hit the rebalance button when I want to rebalance or whatever. And I don't know, this I assume changes. I assume it gets more conservative over time, but I actually haven't studied the M1 target date retirement portfolio. So I don't know if the allocation changes over time or not. But in any event, it's easy to manage in M1 Finance, so that'd be one approach. But yeah, that does seem to be unnecessary. It's like they could accomplish basically the same thing with just a small cap fund. Russell wants to know what my thoughts are on using NUSI, XRMI, or QRMI rather than bonds. I have no idea what those things are, but we're going to find out. Maybe I do, and I just don't recognize the letters. NUSI. Oh, we've looked at this. See, I just can't remember all the tickers. Nationwide Risk Management Income ETF. So I'll give you an answer that isn't specific to the fund. So like the question might be, this is an income fund. We can look at the portfolio. And the first thing you see here is that this is a stock portfolio, right? We can see 97% U.S. equity, the rest non-U.S. equity. It's growth, but it's managed income, right? So if we look at risk, so this doesn't have any risk details on this fund, and I wonder why that is. That doesn't make sense unless they hedge this somehow, but still there would be risk. I'm going to look at performance. Well, it's a brand new fund. That's part of the problem. So yeah, I mean, it's really hard to comment on a fund that's only got basically 1 year of data. I'm going to go back to the portfolio for a second. They have some short positions, but it's pretty much a long fund. And it invests, I want to just see what it's, yeah. Yeah, so, and I can look at the others you've mentioned, but I don't see this as an alternative to a bond fund, at least from what I've seen so far. It's a stock fund, so it's risk, it's volatility, it's expected returns are all going to be very different. Now they call it a risk managed income fund. So I guess I should make sure I at least have some idea of what I'm talking about, because they must hedge their risk somehow. They must hedge this somehow, right? Let me see if I can pull it up. I mean, otherwise, what's the risk managed? It's managed risk. Whenever you manage risk, it gets expensive. They're advertising this as a different approach to income. Let's see here. All right. They purchased the NASDAQ 100. Deploy a rules-based options collar strategy. There we go. All right. Well, this is starting to explain everything. Monthly distributions. Yeah. How much does this thing cost? 68 basis points. I mean, for what they're doing, the one thing that expense ratio doesn't cover are transaction costs, which could be high. But I'm just gonna, I say this every now and again. I just have to do a deeper dive on that. I can't dismiss it. It's not generally the approach that I take to investing, but that doesn't mean it's a bad one. Whether though it's a bond alternative, I mean, they're trying to generate income, and yes, bonds have interest, but there's also capital gains and losses on bonds. I'm sure there is, obviously, for this. Well, I shouldn't say obviously, but because I don't know, I'd have to know more about the option strategy. So that's going to take some time. I'll have to dig into that more deeply. I don't, sometimes you just got to say, I don't know. Sean says, Rational Reminder podcast, which is a great podcast. The good company is a good investment fallacy. So I haven't listened to that episode, but it's absolutely true. Just because there's a good company doesn't make it a good investment. Absolutely true. Because remember, with investment, you got to deal with price, right? You have a great company that's just insanely overvalued. All right. I think we may be coming to the end. It is 1 o'clock. Larry says that the target dates at M1 do get more conservative over time. Thank you for that. Last question of the day, and then for those of you that are still hanging out, I'll do a few chess puzzles, although my chess rating over the last week has not done well. Paul says, BND versus VTIP. I've moved a good deal, a bit of BND to VTIP. So VTIP is a TIPS fund. BND is, treasuries and corporate bonds. Does this make good sense for rising bond rates? Well, if inflation continues to go up, the TIPS could do well, right? Interest rates don't, will eventually follow, right? But what happens if inflation goes down next year? Which it could, right? I mean, we may be battling inflation more than some thought, but that doesn't mean some of it won't, some of it could still be transitory, right? And that's why I still come back to this sort of half TIPS, half, I'll call it regular bonds. To me, is probably the most sensible way to have exposure to bonds without having an opinion on future rates or inflation. so, and that's kind of where I am. So moving some B&D to VTIP seems reasonable to me. The one question I would ask is, are you chasing performance? VTIP is a short term. That's something to keep in mind. VTIP is a short term fund. Its duration is, I don't know, we can look it up, 1 or 2 years. B&D is an intermediate term, so that's something to keep in mind. So VTIP is 2.63 right here. But one question would be, TIPS have done better here recently, and is that why you're moving? And I would just there's part of me that would say, I'm going to wait until TIPS are sort of underperforming, and then I'll move if I'm going to make that decision, just to keep myself from trying to move because one asset class is seeming to do better. It's one of the reasons I probably, I've avoided commodities for a long time, and then when they start to go up, all of a sudden in my mind, I start to think, boy, exposure to commodities might make a lot of sense. And I have to stop myself. Like, no, you're just saying that because the price of oil, or whatever, has gone up. Anyway, this has been an exhausting one for me. I don't know why. I feel low energy. And so there's still 200 of you, which God love you. Thank you for watching. I will have a timestamp up later today. I will show you, we'll do a couple puzzles. So for those who want to hang around, here's the thing about, so there are a lot of chess players, some obviously grandmasters who are much, much better than I am, some around my playing strength, some that maybe are newer to the game, and they're very popular on Twitch. And they play speed games with viewers watching and chatting and commenting. Here, I'll show you, we'll do a puzzle here. Actually, can I, there we go. No, I'm still up there. I don't know how they do it because I'm going to hit a button here. It's going to put a puzzle up, but knowing that folks are watching, it just kind of freaks me out. It's like, I don't know. So they're actually playing speed games. And I don't know how they do that while they've got all the, some people, thousands of folks watching. I don't know. So, and these are tough puzzles. My rating is down. I was over 2,900. Now I'm 2727. I don't know. So my first thought is queen to here because I'm threatening mate and I'm threatening check, although that wouldn't be mate. And the other problem with that is I've got to watch the rook down to e7. Of course, he's also got a check here with the knight that I got to think about. I'd love to take his rook, but I can't figure out how to make that work. I mean, I can give him a check here, but so what? Then he just moves one way or the other and I got nothing. Can I take the pawn? Maybe that's the answer. Because then I check here. I think I check there. What if he goes here with his king? I can win the rook, but that's without check. And now that might be okay. See, this is where I get nervous because if people watching, and what I really want to do is do a deep think on this, but then I think, well, people are going to get impatient. I should just ignore you guys. Rook g8. That seems too slow to me. Well, first of all, he would take my queen, I think. Queen takes pawn. Queen takes pawn. Yes, that's true because he can't capture back, but it's without a check. That's what concerns me. And then what's my follow-up? Well, my follow-up would be checkmate, but if he checks me, my concern is if I take this pawn, rook, I did not, look, I moved that and I didn't mean to. Dumb thing. If I take this pawn, all right. My concern is he'll move his rook down here, check. Now I got to sort through all of the permutations. Well, since I've already messed this puzzle up, I'll do Salty's move first. Yeah, it could be a good one. No. So I'm thinking the answer is this guy. And my thought was this. I was having a hard time now with the follow-up. Obviously, I can take the rook, and I'm threatening all kinds of things. I don't have any other safe checks. Huh. Well, now I can win the queen, right? Because, right, you just do this and that, and he's got to take it. All right, maybe I should just go on with my first instinct. Jim, thanks for joining the live Q&A. I hope you just didn't just join while we're playing chess. But glad to have you. All right. So here, I can attack the queen, right? That's the first thing my eye sees is rook f8. I've got to worry about d5 because he's got a knight and a bishop on it, and he could pin my queen to the king. That would not be good. And rook over, queen moves, bishop f2 check. He'd have to move the queen to e2, right? So to protect that knight, otherwise I could take it. I'm looking at crazy things like rook over, bishop check, knight to d4, takes, pinning the knight to the queen if it went to e2. I'd like to push, but of course I can't because of the bishop. Well, I'm going to start here because I think that's the right move. I didn't even look in the chat. Rook f2. Oh, that's strong. I like it. What's my follow-up? I was looking at bishop attacking this knight and trying to figure out how to attack it further because it's pinned right now. But if I do rook down, queen, well, queen could come out here, or even queen could even come out here to g4. No, he couldn't. He'd lose the bishop. So he's really got to go here. I can move my queen here, but yeah, that seems slow. All right. Knight f5. Yeah, that's a move. I looked at bishop first, but then, of course, if I do that and then knight f5, my bishop's undefended. But I'm still not sure what that gives me. I mean, I'm attacking the knight, but I don't know. I still think it's bishop f2, but I'm sure I could be wrong. And I am. So we're going to go with rook f2, and that is correct. Well, so that's interesting because now you just take it, right? And then you win the bishop. So here's that we have to analyze, and we have to ask, okay, but why not just go here? What did I miss? Well, it's some long variation starting with knight e5. Huh. Yeah, this is one issue I have with some of these puzzles. I guess this is, I mean, it's a strong move, but I'm not sure I'd call this a combination anymore. Knight f3. Yeah. It goes on. Well, knight f2 won the day. I don't know if you guys saw all of that. I sure didn't. I don't know. We got to checkmate him or win serious material. We're down a rook. There's all kinds of moves to consider. There's knight here, check. There's taking the knight or the bishop. There's, of course, taking this knight, although I'm not too excited about that. If we take, knight check, check here. What do you got on? Okay, you guys aren't helping me in the chat. I'm still surprised that so many people watch at this point. It's like watching paint dry. This is awful. I don't know why I like the game of chess anymore. So I'm thinking knight takes, if I take that, he can take here. Yeah, I have a discovered check, but so what? Win a pawn? That can't be right. Well, then I win the knight. All right, I'm doing it. I got it wrong. So maybe it's the check. Yeah, it was the check. Checking here doesn't seem to get me much. He just goes here. He's got an escape square. Yeah. I saw it when I got to that point, because the issue is with the bishop there, there's mating threats. It's like he's going to lose the rook. Yeah, he's going to lose the rook. Nothing. I mean, if he moves it, then you got checkmate. I guess he can move it here, but it's not going to help him. He goes here. Mate. So that's my big problem in chess, is that I see, like, in analyzing this position, I considered knight d5, but I couldn't see it all the way through. And I just didn't see how powerful knight takes knight, getting my bishop here. I just missed it. It's not good. So where do I move the king? Or do I interpose a piece? Unlikely. I can't imagine this is the move, because he can just win the bishop. This can't be the move, I wouldn't think, because he's got two. I'm going to go here. All right, so now, how do I take back? I think I take with the king. Isn't the whole point of this to win one of these pieces? Yeah, hey, we finally got one. Did you guys see all that? Is anyone even watching? Yeah, I would be like the worst as a Twitch chess person. So I'd really love to be able to check him right here and mate him right here. I just don't think I can, at least not unless I can figure out a way to deal with that bishop. What if I just move this rook right here? He's got no checks of any usefulness that I can see. I'm threatening check here and mate. If he goes here, I rook down. He's got to go back. And yeah, So how would he stop this? I don't know. There we go. That's my answer. Wait, see, no, I didn't see that. Well, I could win a piece. I guess that was it. I thought I was getting checkmate. All right, as soon as we get below 100 viewers, I'm ending this live session. We're at 108. Oh, now we're at 111. All right. I got Mr. Rook here. Queen there. They want to do bad things to my king. I've got no easy checks at all. I'd love to queen this pawn, but that ain't happening anytime soon. I can't attack the rook. He'll just come down here with the queen and cause havoc. So the question is, if I move my queen here, I'm threatening queen down here, causing my own form of havoc. And there ain't much he can do about it. He's got a check here, but I can deal with that, I think. I'm thinking that's the move. So here, I don't want to go here because he'll check me here. So I want to run away from a check. So I think that's the answer. And now I go there. Huh. So I end up winning the rook. All right, look at that, 3 in a row. 107. Okay, I'll still go until I'm under 100. Well, why can't I just move my knight to d5? Double attacking his bishop and his rook. He can take one knight, but I take back. He can take my rook, but... So now the question is, does it matter which one I take, or which one I move first? It probably does. It always matters. Whereas if I move this one first, he can't take my rook right away. It's got to matter. I just don't see how it matters. Maybe the issue is if I move this knight. So when I move this, he can check me. That's the issue. Takes. I think it's this one. If I move this one, he can check me right here first, which moves his queen out of harm's way, at least momentarily. And then he could even trade his queen for 2 rooks if need be. So I'm going to guess it's this knight. Oh, so now, and now he can't check me there, obviously, because I could have taken. And here, I think I just, what? Oh, I'm supposed to take here first. No, I'm not. I take the queen, I guess. Look at that. See, that's typical me. I get to that point and then just botch it. I don't know what I was thinking. Surely I've gone below 100 viewers now. No, 110. I think you guys are just staying on now just to toy with me at this point. This is just, let's see if we can drive Rob insane. And it would not be a long drive. This kind of looks like a Bobby Fischer kind of situation, but so I'd love to put my bishop right here, but I can't at the moment. What happens if I move my queen to here? I'm threatening the bishop move now to win his queen. He can't move his king out of the way because I'll just take his rook. How else does he defend? He can't defend here with his rook, or I'll take it. He can't move his rook here. I would check and then check. I'm going to do it. I think this looks to me like a Fischer game. Don't I just do that? Yeah. This strikes me as a game played by Bobby Fischer, but I could be wrong. I usually am. Well, this looks easy. I just march the pawn down and queen. But you know it ain't going to be that easy. That's got to be my first move, right? Now, I think I want to move here with my king. Maybe not. Yeah, now I'm gonna, do I want to go this way or do I want to go here? I'll go there. Here's the trick. I can't push that pawn, I don't think. I got to go here. Oh, is it a pawn push? I guess it is. See, there's a perfect example of just a dumb move. Just a dumb mistake. I don't know what's wrong with me. Clearly, see, I'm at 100 viewers now. You guys are like, this guy's pathetic. He's not talking about money and his chess skills are terrible. All right, but I'm at 101 now. All right, one more puzzle. As soon as I look at that number and it's under 100, I'm out of here. This is embarrassing. He's attacking my queen. Why don't I just take it? Why don't I just take the, I don't get it. Why don't I just take the knight? There's a reason. What am I missing? Maybe the chat can help me. Nothing. Triple Threat said, this is not what I expected based on the title. Yeah, I hear you. I'm taking it. Okay, so the threat is here and attacking my horsey. I still don't get it. Why? I mean, I can move here. I don't think I want to move this rook. I could maybe with bishop back, but that concerns me. What's wrong with this move? I guess he would just move the queen here, but then I could attack with the bishop. See, now that is exactly an evil puzzle because it's so obvious you're just convinced you're missing something. And then the next puzzle, you think, well, this one's easy, and you miss something, it's completely fouled you up. See, chess.com, they play games with you. This is a psychological battle. All right, maybe that's a bit extreme. 104 viewers. All right. Well, I can check them. D3, I got that going for me. I can check them, H4. So I could check H4, pawn push, take the pawn with the queen. I mean, with the bishop. Pawn takes bishop, queen takes. He moves to, let's say E2. No, because then I like that. I like bishop because If I check him here, he moves. Well, if he moves here, I'm going to castle with check. So that can't work out well for him. If he moves here, I can check here. He can't go here because that knight's strong. He goes back, then I can take the rook, and mayhem ensues. And if he doesn't, what if he doesn't push? He moves the king to here. Then what do I have? Not much. Oh. Yeah, in some ways, bishop there, he moves king e2. That kind of helps him, doesn't it? I almost wonder if castle is the right move. See, this is one that could be tricky. The thing is, if I move here check, he doesn't have to push here and then I take and then he takes and I get my queen in there. He can just move here. He's connected his back rank, rooks and queen. I don't have a check. Again, I could do this. He's going to move up. Yeah, I can take this pawn and attack the queen. But if I castle, now this is a big threat because if he just moves his king up, I got rook right down here, right in his face. I think good for him. Now he's got to move back. I got discovered. That's my thinking. Any help in the chat? No, but hey, Rob, I love your content. The finance space needs some calm and collected advice. Thank you for what you do. You're welcome. Oh, look at this, Fast Eddie, castle. Okay, I'm doing it. If Fast Eddie said to castle, I am all in. Oh my word. I didn't think that was it. So am I just collecting like a stupid pawn? Really? I just still find that hard to believe that that's the answer. I could collect that, or I could move my queen here. I don't think I want to give up my queen. But maybe I do. No, I don't. So what am I missing now? Oh, no, that doesn't make any sense. There's something deep going on here that I just don't get. Oh, no. First I thought I could take the knight, but I can't. Oh, yes, I can. See, there you go. I'm like blind as a bat. Okay, I clearly have to be down under 100. 103. This is starting to get personal now. So I hate these kind of puzzles because now I got to figure out what in the world to do with my king. See, I'm starting to yawn. This can't be a good sign. Goofy puzzle. By the way, the reason I moved this here is because there's effectively no checks. I mean, yes, the queen can come here and check, but I can interpose the pawn. Here, he's going to check me down here. It gets ugly. Here, he's got all kinds of checks. Anyway, that was my thinking. All right, 97. Yes, finally. Some of you hung up. Thank you. No, I'm just kidding you. Always, it's been fun. I'm exhausted. I got to go. I will do timestamps, but I need a break. I need to eat something. So I'll get timestamps below the video shortly. Thanks for watching. Appreciate it. Have a great week. And until next time, remember, the best thing money can buy, it's financial freedom. I'm out of here.